You're watching the ET Money Show. Let me take you through what happened in the equity markets today. In fact, it was a bit of a dreary day for the Indian equity markets, if I can call it that. You had the Nifty 50 lose quite a bit of ground, as you can see, down about 2.65%. And this is not an isolated incident. This is something that's happening across the globe. You had overnight quite a big drop in the US equity markets as well. Broader markets also corrected quite sharply today. And particularly the Nifty IT index was badly hit, in line with what's happening to tech-focused stocks around the world. That index dropping as much as 5.7%. But you had commodity-focused stocks also that underperformed. You had the metal index as a whole that ended lower by about 4%. Also one of the worst performers in trade today. Why am I talking about this? I'm talking about this because if you have a portfolio of stocks, you are probably seeing quite a bit of capital getting eroded in that portfolio of stocks. And these falls also present opportunities to average the price of the holding that you have in stocks that you're convinced about. To talk about understanding the valuation of the companies that you are interested in investing, perhaps companies that you already invest in, I have with me Anant Ladha, who is the founder of Invest Aaj for Kal. Thank you so much, Anant, for taking the time. I've set the context for you. Help us understand how an investor should react to these days, right? You've had such a sharp fall in the benchmark indices, and this is one fall in many that we've seen over the last month or so. So how does the individual investor with a stock portfolio react?
Hi, Alex. Firstly, I would like to say that I can completely feel the pain of investors because even there is some pain in my portfolio as well. So it is part of the game. We know that this is difficult time, but this is the time where your patience will be tested. What happens in market is after a beautiful rally, we had good 2 years of market rallying. Then we are having this consolidation period. It is the most important time for you to survive in this market. This market is bound to give you returns provided you survive and you are there when market is ready to rally. So hold on to your stop losses, respect your stop losses, respect market. I know the biggest reason for not following your stop loss is your ego. What happens is we might be really good in our field. Someone who is listening to this video and this complete conversation might be a very successful chartered accountant. Someone might be an engineer. Someone might be from IAS background as well. You are very good in your profession, but you have to understand that in this market, market is supreme, market is God. If market is saying that your stop loss is hit, respect it and get out of it as soon as possible.
Let's talk about valuations. Okay,
Sure.
and this is something that is very important, I think, for the individual investor to also understand. In a conversation that I've had with you, you've mentioned that PE is not something that you look at, or price to earnings, as they say, the price to earnings multiple, price to book multiple. You don't look at these things. Why do you not look at them?
Basically, I have to frame the context. There are two styles of investing. First is value style, second is growth style. When you start investing in value style, I feel that it is a very difficult style to crack because you might see value in some stock, but when market will realize that value, you never know. So whenever I want to invest in value style, I usually go by mutual fund because there's a basket which is there in which I'm investing. Second style of investing is growth style. When you are investing in a growth style and you invest based on P ratio, you will probably miss out all the winner stock of that particular rally because there's a concept of P expansion as well, especially in bull run. What happens is whenever a stock is breaking out, whatever was its PE, when it broke out, PE can expand up to 100 to 150% in a roaring bull market. Suppose when a stock was breaking out from its level, at that time its P ratio was 40. Till the time that the stock is rallying, its P ratio can even reach up to a level of 80 or maybe 100 for that matter. So in roaring bull market, when you are a growth investor, P ratio is not important for you. Any which ways, P ratio is an end effect, not a cause for any particular stock to rise or fall. There is I do listen to a lot of people and some people say that this stock is available at a low P. That is why we should invest in that stock. it might be a case that market is giving that particular stock low PE as compared to its peer or as compared to complete market, because this is what that stock is deserving. So don't run after PE in one line. It is just an end effect and not a cause effect.
Um, uh, let's talk about what your perception is on valuations then. How should an individual look at a company and decide whether this is a good level to get into it based on the fundamentals? And I know that you look at things in terms of a combination of fundamentals and technicals, but let's only focus on fundamentals today.
Sure. So I basically feel that there are more than 5,000 stocks in market. To filter from those 5,000 stock and to reach to your list of 50, 60, 70 stock, you need fundamental filters. For me, those fundamental filters are, firstly, I look at return on equity. I make sure that my company's ROE is at least more than 15%. Why do I look at it? Because as an investor or as a trader, we expect that I should generate more than 20, 25 or 30% return from stock market, versus I end up investing in stocks which itself is earning in negative ROE. It doesn't make any sense. So first filter is ROE. Second important filter and third important filter is sales growth rate and EPS growth rate. I feel that before any big run in particular stock, either that particular stock is giving superb results or there is expectations that in next quarter it will give superb returns results. So I think EPS growth rate quarter on quarter and year on year and sales growth rate, these two are very important criteria. And finally is institution holding. For any move, you need big money, and big money is always there from institutions, be it DIIs or FIs. So I track quarter on quarter whether in my particular stock is institution holding increasing or decreasing. So these are the four basic criteria which I look at as a retail investor.
Okay, I take your point. Let's look at each of these one by one, because I'm actually jotting them down myself as you're speaking to me, because this is going to be useful, I'm sure. But you said that the first filter is return on equity, and it's quite an interesting strategy, or rather very logical strategy, to have a wide group of stocks and you put filters and you reduce the basket of stocks. It's a theory of elimination. So
Absolutely.
what is the net, if you can call it that, for ROE? What is the threshold that you need to maintain?
As we discussed in our last conversation also, I like to keep it simple. So your filter is 18% in ROE, 18% in EPS growth rate, and 18% in sales growth rate. And I have kept it 18% just for the sake of simplicity. At times, there might be some stock where ROE is maybe 12%, 13%, but as an exception, you can consider it if technically that is forming a beautiful chart. But to keep it simple and silly, 18% for EPS growth rate, sales growth rate, and ROE will make sense.
If I were not as optimistic as you, or maybe if I were okay with a lesser growth rate, I could arbitrarily choose a 17% or a 16%. Is that what you're saying?
Absolutely. See, as a retail investor in my portfolio, I just need 10 to 15 stocks. That's it. I am not a coin collector that I will come in this market and collect all the stock which is available and keep it in my kitty for my grandchildren to watch that I have such a beautiful collection of stocks. I am an investor. As an investor, you just need 10 to 15, maximum 20. Even if your portfolio is in crores, 20 stocks will suffice your portfolio in direct equity. Why to go with second option when you can go with the best option? That is why I'm keeping my filters high. But if you have some better opportunity technically and you think that just because of a particular filter you are missing on that opportunity, obviously you can make some changes.
What about consistency? Because there could be a one-off incident that leads to a miss on any one of these filters, right? You've identified 16, 20 stocks, as you say. Because of certain issues in a particular industry or a particular sector, there has been a miss. How many misses, according to you, will it take for you to reconsider your decision to include a stock in your portfolio?
One miss for one quarter is absolutely okay. Second miss, I'll become cautious. Third miss, I will remove that stock from my radar for at least some period of time till the time that stock again proves itself. shows me that why that stock is deserving a place in my portfolio. If that happens, I will obviously re-add that stock. But more than two misses, I will remove that from my focus list personally.
The other question is, while you have said that PE is an outcome rather than something that should make you choose to invest in something or not, if you take this criteria that you have said, you say you're looking at ROE, you're looking at sales growth, you're looking at EPS growth, you're looking at institutional holdings. You've drawn up a list of stocks that you want to invest in. What if they are too expensive? What if, so my question to you is, if they tick all of these boxes, would you be willing to buy it at any price?
Absolutely not.
Okay.
So after applying these filters, you will probably get a list of 50 to 100 stock at a particular time. Now you have to see technically which stock is giving you entry according to your technical indicators, or maybe according to your technical strategy which you are following. That is completely a different topic, which probably we can discuss in detail. But yes, fundamental filter will filter out stocks for you. When to enter in that stock, obviously you need some strategy for that. Just because a stock is fundamentally very sound, randomly at any price we cannot enter. Otherwise, our risk to reward ratio will not be in our favor. So that obviously we have to take care of.
You have a criteria in terms of market capitalization, because I know that some investors choose to invest in stocks of a lower market capitalization because the potential for growth is that much more. Are you of that opinion as well?
I am okay to invest in large caps, mid caps, and small caps, but micro caps I completely avoid. I want at least in my stock daily volume in terms of rupees should be more than 70-80 lakhs, so that there is no liquidity issues.
Okay, so you don't have a threshold in terms of, I mean, you do have a threshold in that you don't invest in micro caps, but I'm guessing 1,000 crore above is something that you look at. Yeah, okay.
At least.
Okay, lastly, I want to talk about, suppose you have a retail investor that has a basket of 20 stocks, as you've said. Do these 20 stocks have to have a stop loss individually, considering that you will hold it, assuming that you're holding it for the long term, you're going to hold it for the next 5, 7, 8 years. Should you worry about a dramatic fall in a stock?
I would personally be worried, because my personal strategy is whenever I want to invest for long term, for a goal, I use mutual funds and index funds. Whenever I am investing in a stock, I will not personally get attached to name of any stock. I will personally have maximum stop loss of 10% in a particular stock. Reason for having this 10% stop loss is any one particular stock, I don't want that stock to eat up more than 1% of my total capital. How that 1% is coming is very easy. If you have 100 rupees, at least you will have 10 stocks in your portfolio, weighing 10% each. 10% on 10%, if there is a 10% stop loss, it is 1 rupee stop loss on your 100 rupees portfolio. So in one particular trade, you will lose maximum 1% of your capital. If we are able to manage our maximum drawdowns, you are bound to become successful investor. There are 5 possibilities: super gains, small gains, neutral, some losses, and major losses. We just have to eliminate the 5th part and we are taken care of.
Fantastic. I think this is great advice. Thank you so much, Anant, for taking the time. Appreciate it.
Thank you so much for having me on the show. Thank you.
All right.